Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Friday the 12th of May. And just a reminder that we're on iTunes, Spotify and Google Podcasts. And if you go to my website, peterlewismoneytalk.substack.com, you'll find all the links to your favourite podcast apps. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's consumer prices increased at their slowest rate in 2 years in April. China's annual inflation rate fell to 0.1% year-on-year from 0.7% in March, and that missed market estimates of 0.4%. It was the lowest print since February 2021. The producer price index fell for a seventh consecutive month, losing 3.6%, faster than a 2.5% drop in March, partly due to softening commodity prices. The Bank of England has increased interest rates by 25 basis points to 4.5%, the highest level since 2008. That's the 12th consecutive rate rise from the UK Central Bank, and it warned that if there were to be evidence of more persistent price pressures, then further tightening in monetary policy would be required. Wholesale monthly inflation in the US rose by less than expected in April. The producer price index, often viewed as a proxy for where inflation is heading in several months' time, eased for a 10th straight month to 2.3% in April from 2.7% in March, and that's the lowest reading since January 2021. It was also below forecasts of 2.4%. And excluding volatile food and energy prices, core PPI rose a monthly 0.2%, while its increase over the past 12 months moderated to 3.2%. The Philippines' first quarter GDP grew 6.4% year-on-year. That's higher than the 6.1% expected by economists, and after a downwardly revised 7.1% gain in Q4 of 2022. This was the 8th straight quarter of expansion in the economy, but it was the lowest growth in that sequence. On today's programme, I'm joined by Francis Lund, the CEO of GEO Securities, and William Marr, Chief Investment Officer at Grow Investment Group. With a view from Australia is Toby Lawson, Director at Statton Advice. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks were mixed on Thursday as concerns about the health of some regional banks undercut optimism that the Federal Reserve could pause interest rate hikes after better than expected inflation data. The S&P 500 index declined 0.2% to close at 4,131, breaking a 4-day winning streak. The Dow declined for a fourth straight day, shedding 222 points or 0.7% to end at 33,310. The Nasdaq Composite added 0.2%, ending the day at 12,329. Shares of PacWest tumbled almost 23% after the Los Angeles-based bank revealed it lost almost 10% of its deposits in the first week of May. The majority of withdrawals were on May the 4th and 5th, following reports that the bank was exploring strategic options, including a sale. The news hit the share prices of other regional banks, dragging the KBW Regional Banking Index 2.4% lower. Alphabet shares jumped over 4% higher to trade near their highest level since August, and the shares have gained more than 32% so far this year. Google announced a range of new artificial intelligence features at its developer conference on Wednesday. Hong Kong stocks gave up early gains and turned lower. The Hang Seng ended the day 18 points or 0.1% lower at 19,744, and this morning futures markets are pointing to a small decline of 0.1% for the Hang Seng at the open. The tech index jumped 1.3% higher. In the mainland, the Shanghai Composite fell 1/3% to 3,310. Bank shares rose once again after Beijing asked commercial lenders to cap some deposit rates in a push to support the economy. The change would imply a drop of about 40 to 55 basis points from previous ceilings. A gauge of Chinese financial stocks jumped as much as 1.5% following the news. And Chinese electric vehicle maker Li Auto surged 17%, that's the most in 6 months, after reporting record quarterly earnings. The car maker made a profit of 933.8 million yuan, that's about 135 million US dollars in the January to March quarter, reversing losses of 10.9 million yuan last year. The company delivered almost 53,000 units in the quarter, that's an increase of 66% from a year earlier. You can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's go and welcome our guests. We have with us Francis Lun, who is the CEO of Securities. Morning to
Hi,
you, Francis.
good morning.
And also with us up in Beijing this morning is William Ma, up in Shanghai, I should say, William Ma, who is Chief Investment Officer of Grow Investment Group. Nice to talk to you again, William.
Hey, Peter.
Let's start with the Chinese economy. China's consumer prices increased at their slowest rate in 2 years. According to the National Bureau of Statistics yesterday, annual inflation just 0.1% year on year, declining from 0.7% in March. I mean, Francis, what a big difference between the US and other economies and China. How do you explain this?
Well, I think the Chinese economy been insulated from the global market for quite some time because America tried to cut off China in terms of tech and other things. But the important thing is China managed to keep its energy costs at bay. I think China didn't experience a sharp rise in the energy costs. And then in recent, the price of grocery, food items actually fell. And so that's why the CPI is down to 0.1%. But it also shows an alarming feature in that demand is not very strong. I think that's why the CPI is not hardly growing at all. And it does not bode well when you take into consideration of the PPI, which is falling for 5 straight months. That shows the manufacturing sector, the factories, especially the export sector, is not doing that well. Import is falling by 7.9%, but export is growing by 8.5%. Both are not very encouraging. So some people believe that China can achieve a 6% growth this year, but with these kind of figures, I think you better stay with 5.5% growth.
William, if you take this data and then also the trade data that we had earlier from the week where imports dropped quite sharply, it does tend to suggest that demand is looking quite weak, doesn't it, on the mainland, particularly in the manufacturing sector?
Yeah, exactly. I think on the export side, definitely this is something to watch out for. I think a lot of it has to do with the orders, from the U.S., in particular when we speak to some of the business owner of the export companies, like in the textile in Ningbo. I think their orders in Q1 this year has dropped quite a bit, but they're also telling us that actually, after this round of, slowing order, they are seeing orders slightly coming back. So on the export side, I believe it would take at least a quarter of 2 to recover because of the kind of like U.S. recession concern. And Peter, on the China side, I'm relatively less bearish compared to some of the peer groups. It's because I think if you look at the CPI number, besides food, from on the ground domestic demand, I can see the recovery is there. In particular, if you look at April and May. And second, if you look at some of the bigger tickets item, like the cars, right? I think the number is also reasonable. May 1st travel is reasonable. And I think from my experience, it has to be 2-step in terms of cycle, right? The first step is consumers start spending, and then business owners see, the economy is not as bad as you thought, and then they start hiring. So I believe, at least the first leg is already here, and I'm less bearish compared to, some other people, in the market.
Are you worried, William, about the divergent trends that we're seeing now between the service and manufacturing sectors, where the service sector looks quite strong, doesn't it? But manufacturing is in the doldrums. Do they sort of affect each other at all?
Yeah, I do, to be honest. But with hindsight, look at what happened since, January. Because if you look at the reopening trade, it's merely about 4 months. So what we have achieved in the last 4 months is quite miracle from my perspective, that the consumer demand is so quickly. And on the manufacturing side, we have to give them some time. And unfortunate, I think the kind of like demand is both quite weak from global and to some extent on the China side. So I think the figure to watch, if you like, for the next few months is whether, the order will coming back, whether that is sustainable. Relatively speaking, I think there could be some surprise on the upside, in particular in the equity market, because most people are quite concerned about it.
Francis, it's going to take presumably a pickup in the global economy to really help China's manufacturing sector, isn't it?
Yeah, definitely. Look at one very hot consumer item, which is the smartphone. The market says the demand for a smartphone is down 15% this year. And you see the chip makers, TSM and Samsung, reporting lower sales for 2023 and especially for the second half. And I think what's happening is that the sharp increase in interest rate in Europe and in America are really starting to hurt consumer demand. People have less to spend, and they are pushing off buying a new smartphone. That's why you have slower demand for manufacturing goods all across the globe. It's not just a China phenomena. I think other export economies like Japan, Korea, and Taiwan are facing the same problem.
William, there's been a lot of talk recently among Chinese the leadership to sort of build a new modern industrial system where they want to focus on things like high-tech, AI, electric vehicles, that type of thing. What are they doing to try and achieve these sort of breakthroughs? Because they see it very much, don't they, as they need to fight back against the US and its industrial sort of policies. But are you seeing signs that China is making progress and this is starting to feed through?
Well, this is a long-term plan and target. And Peter, it didn't start like this year or so. If you wind the clock back about a year or two, I think there are certain measures being in place. For example, the original one is the listing of the Star Board, right? The technology board in Shanghai. There was quite a smart move from my perspective that you provide exit for some of the tech company to get listed and get proper, funding and capital. The second is on the private equity and venture capital side. I'm seeing some domestic government, they are launching VC funds, that they invest and attract companies, set up and in their own provinces and cities and potentially kind of like, invest in the high-tech area. I think that part is ongoing. What is the latest move, if you like, or development is I'm seeing some of the VCPE fund start raising capital from the local government again. So which means the direction from the Chinese government in subsidizing or promoting technology is coming back, after the COVID. This is a good sign. But again, Peter, I think it would, take a while before, those companies grow bigger and then grow listed. And last but not least, I would, envision more kind of like certain sector-driven technology reform. One key catalyst or sign that I saw in the last month or so is the car manufacturing sector. If you look at the Shanghai Motor Show, actually the reception of the local Chinese brand is outside my original expectation, which if it discontinue, it will drive kind of like a whole new, value chain across the system. For example, we were being pitched some of the kind of like supply chain for the car manufacturing companies. For example, components in terms of, laser radar, or some of the sensor or some of the motor. If you recall, back in the 80s, in Japan, the automobile industry was a key driver for a lot of, manufacturing sector. So if this trend of, Chinese car manufacturer continue, I believe there is also one good component of, local driven kind of like manufacturing support, besides the many people talk about AI or chip manufacturers.
Francis, AI, I mean, William just mentioned that, the big topic of conversation at the moment, isn't it? So
yeah, everybody's getting into it. Google was the latest entry into the market. Google share prices rose 4% overnight. So the battle, the war is just started, and nobody knows who will win because when I type use my word recently, they automatically put some phrases. It's part of the AI, I assume. So, but it's too early to say who will come up on top, Microsoft or Alphabet or any Chinese companies like SenseTime and Baidu. But it will take some time before we can identify some winners. It's just like the early stages of the tech boom. It took several years before Tencent and Alibaba came out winners. But I hope this round, China, several winners can emerge from China. And this is what the stock market wants and needs.
Well, what about Baidu, William? They've got their Ernie chatbots, haven't they, which they've released. Where do they fit into sort of the global picture in terms of being able to compete with Google and Microsoft's Bing?
Well, I don't know if the Chinese AI can compete globally because they don't have complete freedom in providing information. I think that is the one drawback in AI from China.
William, is it a good sort of theme for Chinese markets, or is it a bit too early at the moment to be able to?
Not at this point, Peter. You know, if you really want AI, I would recommend alternative investment instead.
Right.
Artificial intelligence in China, because to be honest, there is a lot of alpha and new strategy in China, like convertible bond trading, CTA, some of the quant or up strategy. But I think what happened in the AI sector in the last 3 months is a good sign that there are risk capital to be deployed. Because, if you look at the longer term, the China-Asia market lack of a major theme in which you see a lot of momentum is going there. But I think, the high kind of like so-called speculative phenomenon or sharp appreciation of the AI sector indicate the market sentiment is not as weak as people thought in the last 2 months. There are risk capital to be deployed, but people kind of like lack of a medium-term kind of like theme that they want to get deployed. And, to a less extent, the banking sector or some of the SOE kind of like market rally in the last 2 weeks or so, meaning that there are rotation. So there is that is the early sign of a bull market recovery in the medium term, if you like, rather than people are very defensive and not investing in anything.
Francis, one theme that's emerged in the Chinese market this week, which I have to say has taken me by surprise, is the big banks. We've seen quite a big rally in these big banking stocks, which is not where I have to say I would have put my chips. But what's going on there?
Well, that's really from last week, where I think one of the stock market regulators said we have to look at the Chinese shares, especially with special characteristics and special valuation, meaning that their valuations are really way too low. And then in Chinese language, there is what the Chinese special stocks. Like all the banks, insurers, and then the oils and the telecoms, meaning the old economy stocks, all of a sudden soar. But in the past 2 or 3 days, actually, it fell. I think now has some support. I think what cannot be denied is that these old economy stocks actually have very low valuation and very high yield. And look at the banks, their PE ratio is 4 to about 6 times, and the yield is something like 6 to 8%. They are really good bargains. So previously, people feared that they might suffer bad debt, and I think they can control it. So I think even right now, I think these Chinese special stocks are good values for the money.
William, would you be a buyer of these stocks? I mean, it's true that they're cheap, aren't they? I mean, banks on the mainland trade at around 0.6 times book value, but they've always been cheap, haven't they? That's been the case for a long time.
No, actually, yes, and we have been overweight, this sector for a few months already, for this particular reason that Francis mentioned, and I believe the trend will continue, until the yield go down. and perhaps, valuation go up, or there are other major new themes coming up. Because if you look at the retail investor or some of the high net worth, they are still quite defensive, but they are, again, not just happy about getting, 3-4%, from the deposit or some of the fixed income fund. Then when they want to take their feet, back to the market, they look for safety. So no matter in domestic renminbi asset or some of the US dollar asset, listing outside. And the second concern they have, globally is the US market is start correcting. And at the end of, interest rate cycle and recession, the traditional high flyer like Apple alike may not be their favorite kind of light stock. Then this type of, high yield stable stock have some potential upside if the market recover, but stable yield is getting attractive. So the short answer is we are positive, and we believe the trend will continue at least for a few months.
Francis, if these stocks do go on a big rally, it could really boost the overall market, couldn't it? The broader market.
Definitely, especially when we had that big tax in the doldrum. We need some new hotspots, some focus to ready the stock market, because it's trading below 20,000 for quite some time. I think this is terrible for the Hong Kong market. You look at turnover is under 100 billion a day, and it's really a small stock market in terms of turnover. And also the IPOs are not performing well. Yesterday's IPO closed something like 20 to 30% below the listing price. So there is doom and gloom in the stock market, and we really need something to boost our confidence.
What about, William, the US? Do you think that could boost some confidence a little bit? Because the inflation data seems to suggest that we've seen this week that the Fed is starting to get control of inflation in the US, and it's starting to come down.
Yes and no, Peter. I think one of the major themes globally is sticky inflation and weak banks. I think the bank situation is not being resolved, clearly near term, because there will be more regulations put into place. And one of the risks that, we are sharing with our clients is the real estate market in the US, the mortgage part. If will be more regulations, what happened to the ABS, MBS? Would it be another systematic risk, and trigger a collapse of the US market? And second, inflation has been quite sticky. I think, a month data would not comfort people that, the inflation is definitely going down. Oil price can go up again if there is any geopolitical risk, happening. So in short, we are staying quite defensive in the US market.
Francis, well, I'm struggling to get too excited about the decline in inflation. I mean, if we look at the consumer price index, it fell just 0.1%, 0.1% lower from a year ago. It's very slow, isn't it, in getting coming down?
Definitely, even though you have a sharp drop in the price of fuel, especially diesel, still. The food prices are still staying quite high, and also the renters, even though it moderated a little bit, but still quite high. So right now they have inflation rate of 4.9%, but I doubt that the U.S. inflation rate can get down to the 2% level target mentioned by the Federal Reserve. I don't think that they can achieve it this year. Short of a serious recession, when you have unemployment rate going up to about 10%. So I think we just have to wait for inflation to come down. Maybe it will take more than 6 months. There's no way that it will go down to 2% by the end of the year.
William, what do you think about that? How do you think the Fed can get inflation down to its target without causing a massive recession in the process? Because it almost looks like they will have to raise interest rates by quite a bit more if they want to get to 2%.
Yeah, I think at this point, interest rate has lesser impact in kind of like suppressing the demand, if you like. I think inflation, if have to go down, from my perspective, two reasons. Commodity price continue to collapse or go down, in which in envisioning global recession. I think that is a key component, like energy, right? So there's number one. Number two, the consumer confidence, so the economy in U.S. has to go down, significantly so that people stop their kind of like spending pattern and spend less. Then inflation will go down. But I think the sticky part would be the wage, right? So I was in the States in February this year, and I was told, there's a lot of restaurant people, they are quite expensive. So that part is quite hard to go down. If you go down wages, I think there will be unemployment and people would not be happy about it. So I think it has to come from the commodity side as well as maybe the demand side.
Francis, final thought on the debt default crisis. Donald Trump was basically saying yesterday, just go and default unless the Democrats agree to massive spending cuts. He's basically saying it's really psychological more than anything else, he said.
It is a game of political chicken. I think the Republicans and the Democrats are playing it over and over and over again. We're really getting sick of it. And I think each party is daring the other to go the final yard and then say, let's do it, let's default. But I think that I don't think Biden will give up his signature Inflation Reduction Act, because that is his signature legislation. It costs something like $793 billion US. That's the biggest single bill in the history of mankind.
William, final words and final thoughts from you. The debt crisis, we're getting closer and closer, aren't we, to this X-dates, which Janet Yellen says is the 1st of June, when the Treasury runs out of money. Are you concerned from a portfolio perspective?
Not really, Peter. I think we've seen that movie, many times, before, and it will be resolved. I think, to me, it has to go back to the fundamental. I think the recession risk is prominent and people worry about it. And second is, as we discussed earlier, how quickly the manufacturing sector in China will come back. Those are the key indicators. Earning-wise, I think look at JD and Lawson and some other companies. I think the Q1 is quite good. So I think corporate earnings is back on the right track. It's just the manufacturing and export side need more hard confidence that the second leg of recovery is on the way.
Thank you both very much. That's William Ma, who is Chief Investment Officer at Grow Investment Group, and Francis Lun, who's the CEO of GEO Securities.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is Director of Statton Advice down in Sydney, Australia. Morning to you, Toby.
Hey, good morning, Peter.
The big news, of course, this week has been the budget. And I suppose for us listening overseas, the surprise out of it seemed to be this trade surplus. Australia recorded a 4.2 billion Australian dollar surplus in the 12 months up until June. And that's the first budget surplus since the global financial crisis in 2008. So how significant is that?
Well, I think it's reasonably significant, but it's reflected in when you do budgets, and I'm sure a lot of your listeners out there know budgets, it's what you assess the prices that you're going to pay for things and the money that you receive, and then ultimately what ends up happening. And so what's happened in Australia is that the government has always downplayed the price at which they'll receive for commodities, and particularly in iron ore. And if those, iron ore prices were very, very high over the last 12 months or so. So the government's banked a significant amount more revenue off the back of its commodities because they've priced in much lower prices and they got much higher prices. So that's one factor. Secondly, the economy's done better. So again, factoring in better performance, higher wages means more tax. The economy's performed pretty well. So all of that's led to a $41 billion turnaround in terms of what the deficit would have been to a small surplus of around $4 billion. So it's really quite a good news story, but less about what the government's done and more about how well we've done in terms of commodity prices and the economy outperforming what we expected.
And how is the government going to spend that surplus? What are its priorities?
Yeah, so this is going to be a one-off surplus, by the way. The forward estimates have gone. It's going to go back towards sort of $10 to $15 billion deficits going forward because the government's got a lot to spend money on. and they've introduced a cost of living package, which is really aimed at trying to mitigate the impact of higher inflation in Australia. So about a $14 billion program aimed at lower income earners and trying to reduce the inflationary impact. And this is really the point of discussion, I think, which is most interesting in this package is, giving stimulus and handouts at a time when they're trying to fight inflation sounds slightly counterintuitive. But clearly some support around electricity bills, Medicare in terms of bulk billing for those who need it. At the same time, raising taxes around oil and gas, so getting more out of those companies that are generating oil and gas revenues because of the prices, and also, as always and every year, seemingly a increased tax in tobacco because tobacco excise or tobacco taxes are really quite a big contributor to the government coffers. Some in the order of $13 billion comes in from tobacco over the course of the year, so it's quite extraordinary. So
it sounds like then, if you look at the winners and losers in this budget, the winners are going to be the less well-off, and the losers are going to be some of those unfavourable industries that are polluting, and tobacco industries, those types of things.
Yeah, and also I guess what's also coming down the pipe are tax cuts that were legislated a couple of years ago. So for the middle and higher income earners, they're going to get good tax cuts over the course of the next, because they were legislated a couple of years ago, and that will, that's got to be funded as well. So the government's got a lot of costs coming down the pipe. They're trying to raise taxes where they can, trying to control spending where they can. Overall, they're in a pretty good, strong fiscal position right now. But with interest rates going up, and I guess the debate now in the market and how the market reacts to it is this stimulus that they're throwing in, does it force inflation to stay higher, and does it force the Reserve Bank to have to raise rates again? And that's the debate in the financial markets at the moment.
Because we had that surprise rate increase, didn't we, from the RBA just a week or so ago. So presumably they'll be watching this very closely.
Yeah, so the critics of the budget will say, you've just banked in another interest rate hike because you're creating stimulus at a time when they need to rein in demand. That's a debate, and we'll see what the Reserve Bank do. But as you quite rightly pointed out, we did have a surprise interest rate hike, and the Reserve Bank did suggest that they had more in the pipe. We were thinking the terminal rate on rate rises was going to be 4.1%, and we're 3.85. So we're still probably got 25 in. And the markets are probably expecting that that'll be the peak in rates. This budget certainly doesn't alleviate more the inflationary story, but there's a debate on whether the actual stimulus will increase inflation or not.
Let's switch our attention to another country that you know well, India, where you've lived and worked. The key event, I guess, this week has been the state elections in Karnataka, which is one of the southern states. The capital is Bangalore, which is India's technology capital. I think, Toby, if I'm right, Karnataka is one of the fastest growing economic regions of India, isn't it? So it's a crucial state, and also crucial because it's the only one in the south that's controlled by the ruling BJP.
Yeah, it's getting a lot of press, this particular election, because of exactly that point. The incumbent is BJP, and likely to lose to the Congress. The Congress have been the party that ruled in India for many years post-independence. The names you would recognise, Gandhi and Nehru, are all the Congress party, and they ruled India for most of the 20th century post-independence. They've been a shadow of themselves in the last few years as the BJP has dominated. But in Karnataka, as you quite rightly point out, they're on the verge of winning it. The exit polls are suggesting that Congress will win a majority of seats, but not an absolute majority in the House. Just for those listening, I mean, you mentioned Bangalore, and it is probably a city that many outside of India would recognise. But this election will have 53 million voters and some 3,000 candidates. So just the size of India really always amazes me. And I think the results are coming out next week. And it's expected that the Congress will win the majority of seats over the BJP, which is Modi's party, which is the national party, but not sufficient to have a majority, which means there'll be a bit of horse trading, I imagine, in amongst the parliament. But yeah, Karnataka is really one of the fastest growing states, and driven primarily by Bangalore, which is really, as people would say, the Silicon Valley of India. and most of the big IT companies that are either Indian domiciled or foreign companies are based out of Bangalore. So I think it's 43%. Bangalore represents 43% of the Karnataka economy, and it represents 38% of India's IT exports. So it's a very important state.
I've been to Bangalore, though it was about 20 years ago, the last time I went, when it was really starting to develop as an IT hub. I guess I will be pretty shocked by how much it has developed since then. But it really is a very fast-growing, thriving city, isn't it?
I can tell you what hasn't changed is the traffic in Bangalore. Peter, if you go back, it's got no better. No matter how much infrastructure has been put in, they're still trying to get ahead of that particular issue because the city is growing so greatly. But the traffic, and which is pretty true of most Indian metro cities, is extraordinarily challenging.
Does this election have any sort of predictive powers for what may happen elsewhere? Because there are elections coming up in other states, aren't there, like Rajasthan, and then, of course, general elections as well next year. Does this foretell in any way what could happen in those?
I think it's significant in so much as, from a national perspective, I mean, there's an election every day in India, so there's always something to watch politically in India. But from a national perspective, the Congress have been such a shadow of themselves that actually a win here puts them pretty much as the opposition party going in against Modi for the Lok Sabha elections coming up. I think it's in 2024. So really it might be significant enough to say that the Congress still has relevance and therefore can be the major opposition party to the BJP going into the national election. So that's where its significant is. Does it give them some oxygen to build out in other state elections? That's something we'll be watching. But, so that's the significance of it.
And the other thing that is being focused on at the moment in India is its imports of crude oil from Russia. They rose, according to a study from the Bank of Baroda, they rose tenfold last year. Russian oil accounted for just 2% of India's annual crude imports in 2021. That figure now stands at almost 20%. I guess, first of all, this is quite a boon for the Indian economy, isn't it, getting all this cheap oil? But also, I imagine it's being focused on quite a lot outside of India by countries like the US.
Yeah, I think we've had this debate and discussion before, Peter, around the sensitivity of this topic for India. History, post-independence is, India's best ally was the Soviet Union. A lot of, trade and infrastructure and technology and political connections that existed for a long time between the former Soviet Union and of course Russia and India. So it's a very sensitive one to suggest that the West, even in its battle with the Ukraine, can really push India to change its position on Russia. Now, India, to that extent, is trying to play a very neutral hand. Certainly not supporting Russia, but at the same time not, voting against them in the UN, for instance, more standing on the fence. And that's partly because they have to, in that sense, they're tied in militarily to Soviet technology or former Soviet technology, Russian technology. Plus, of course, as you say, imports. India needs to import all of its oil. And so, practically speaking, it needs to take advantage of this situation. So it's a sensitive one, and I think the West have been very accommodating in that regard because India is a powerhouse going forward, and it's an important relationship for the West to develop. And I can assure you that even if Modi and even if the national BJP are more prone towards the West as they go forward, there is still deep-seated distrust of the West, which dates back through the history of the Soviet Union and the socialist sort of governments of India being much more aligned for a long period of time.
Let's switch countries once again, move over to the US. We've had a lot of inflation data out this week, haven't we? Does it give any sense of comfort that maybe the Fed is now winning the battle against inflation over there?
We're close, I think. Both the CPI and the PPI were better than expected. But they're still elevated. I think one of the things that will be chewing in the minds of the Fed is not to go prematurely to necessarily pause. So I think they're really trying to hammer it down. So they might go one more time, or they might back off and sit there. But one thing to be sure is rates are probably going to stay a bit higher. Interestingly, overnight, the Bank of England raised rates and said that there's not going to be a recession, so that's some negative, positive sort of spin. And I think this is similar to what the Fed are trying to achieve in the US, trying to slow it down hard, get rates up, credit demand expectation down, and hopefully be able to pause. So we're closer than we were in those inflation figures. Both CPI and PPI are pretty positive.
Toby, thank you very much indeed, and have a great weekend. That's Toby Lawson, who is Director at Statton Advice down in Sydney, Australia. Thank you very much for listening this morning and this week. Don't forget to take a look at my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and John Schofield, Managing Director of Tempest Investments with a view from mainland China, is Brock Silvers, CIO at Kion Capital. Have a great weekend.
Money Talk